Have you heard you don't need a credit score now to buy a home? Maybe you've seen that headline. And if you did, I get why you'd think the whole mortgage world just flipped upside down overnight. Let me set the record straight. You still need credit, but something big did change in a way lenders decide whether you get approved. So let's talk about it. My name is Corey Bonner, and I run Max Property Management. With over $1 billion assets under management in over 3 states and a whole lot of experience dealing with borrowers, renters, buyers, and developers, I try to make this stuff simple because real estate world loves to overcomplicate things. It's really not. So like and subscribe is you appreciating this type of resource. Or I'll go back to making videos about, the beard. Today we're going to talk about the truth behind the credit score doesn't matter idea, who it affects, why it's happening, and what it means if you're a buyer, investor, developer. And if you want to see how it hits BTR specifically, I've got a deeper breakdown at coreybonner.com/case study. Go take a look. So here's the real story. Fannie Mae announced that they're removing the 620 minimum credit score requirements from their desktop underwriter system next November. And I know that sounds huge, but it doesn't mean lenders are tossing out the credit reports. Think of it like this. For years, the rule was if you're under 620, don't even bother. Okay, don't even start looking. Even if everything else in your life looks solid, good rent history, stable income, savings, the one number shut the door. Now, instead of treating you like a score, DU looks at the whole financial story. Not a free pass, not a giveaway, just finally taking the blindfold off. Why are they doing this? Now, anytime something like this changes, people ask why. There are 2 honest answers. Number 1, access. There's a big push now to help people who've been locked out of home ownership. People who pay rent on time, don't use credit cards, have thin files, or are new to the country. Now, number 2, technology caught up. We're not using the old school credit models anymore. We're moving to AI-driven systems. The FICO, 10T, and the Vantage Score 4.0 that track real behaviors. Now, this is where even Max Property Management is moving to the Vantage Score when we start to qualify renters. So it's interesting how this is affecting home ownership. They track real behaviors like rent payments, utility bills, and these are payment trends, they're income patterns. It's more accurate than one static number. And look, the critical side of me is saying this too. It creates more mortgage volume. Politicians love the headlines. Banks love the activity. But at least this time, the tools are better. And even we in the property management industry are using these same trends to qualify renters to get into units. So who does this apply to? This is important. This change only applies to conventional loans run through Fannie Mae's DU system, not FHA, not the VA, and not USDA. And even if DU removes the minimum, lenders can still add overlays. So let me say that again. Even if the DU removes the minimum, lenders can still add overlays on top of it. So if your bank says, we still want 620, that's their call. This isn't the Wild West. It's just a smarter gate, not a broken one. So let's talk about the buyers. Buyers with borderline scores but strong payment habits suddenly have a shot. Now, you still need to qualify. Income does matter. Debt matters, reserves matter, but the door isn't slammed before you reach it. And this is important because the next part is renters. This is my favorite part. This is what we are starting to change. Your rent payments finally matter. If you've been paying $1,900 a month on time for years, that should count. And now it does. We in the property management industry are getting over the whole in a box number anymore. We are starting to use that Vantage score. Now let's talk about sellers. A slightly bigger buyer pool is always good for absorption, especially entry-level homes. Nothing crazy, but helpful. For investors, this cuts both ways. More finance buyers means a bit more competition at the starter level. But when you decide to exit, you've got more buyers who can qualify. It tightens the front end, but opens the back end. Now, let's get into developers. Now, for developers, this doesn't suddenly solve affordability. Okay, construction costs, land prices, interest rates, those are still the big bottlenecks. It's real, but it does help people qualify for the product you're building. So absorption gets a little healthier. Now, let's talk about our space that we like to deal in, build to rent. And for build to rent, where I live every day, this doesn't hurt the model. Rents are still cheaper than buying in most markets. Affordability is still rough, and it's going to continue. Demand will stay strong. Yes, a slice of the renters may graduate into buying a bit sooner. But honestly, that's a win for them, and you'll backfill the units quickly. So BTR doesn't get a hit. It continues. The big question, smarter lending or the 2008 all over again? Now let's talk about the elephant in the room. Is this the start of another 2008 dilemma? Or is this the first time we're actually underwriting with modern tools? So here's my take. In 2008, we were approving people who could never realistically repay those loans. Today, we're analyzing real payment history, real spending habits, real income patterns, real risk behaviors. We finally have the ability to see how people behave, not just the number printed on a report. This is exciting. Does that remove all the risk, though? Absolutely not. But it's a smarter system than we've ever had. So the question becomes, are we using AI and better data to lend more reasonably? Or are we stretching the system again and hoping for the best? I genuinely want to hear your thoughts. So here's the bottom line. Your credit score still matters. Don't put that aside. Credit score matters. It's just no longer the gatekeeper, and we're entering into a new era of lending. Smarter models, better data, and yeah, a little uncertainty about what it means long term. But I want you to drop your thoughts below. Is this smarter lending or is this a warning sign? And if you want to see how I'm adjusting our BTR strategy in this environment, grab my full case study at corybonner.com/case study. I'll see you on the next one.